Welcome back to the deep dive. This is where we really try to cut through the noise. We take a snapshot, a really complex moment in trading, and try to pull off the key insights for you. Today, we're zooming in, really specific time, 12:45 p.m. Eastern, October 24th, 2025. And we're looking at the top 40 stocks, the ones that were really moving based on, well, just pure trading volume.
That's exactly it. Yeah, we're skipping the headlines today. Think of it more like a technical autopsy. We're looking at the trading flow itself at that precise moment. We had an AI agent crunch the numbers, build a profile for every single one of those 40 high-volume stocks, basically pulling out their, let's call it technical DNA. We're going to dissect, volume ratios, the true value stuff, implied volatility, squeeze status, and that constant battle, right? Buyers versus sellers, moment by moment.
Okay, and just to kick things off, if you want the one data point that really captures the market's psychology right then.
Yeah.
12:45 p.m., get this. One stock right there on this high volume list was trading at, well, the report says 1,155% overvalue based on its daily true value calculation.
Yeah.
1,155%.
Yeah, that number, it should just make you pause, right, instantly. When you have a statistical model, one that's designed to figure out some kind of long-term equilibrium price, and it says a stock is trading at more than 11 times that value. That's extreme. It signals a massive market dislocation. This isn't, rational price discovery playing out. Got to be something else. Maybe short sellers just giving up, capitulating, or just a sudden, huge surge that has nothing to do with fundamentals.
Right. And what's fascinating is on the exact same list, the same group of 40 high-volume stocks, you find the complete opposite. A stock showing, 16% undervalue based on the daily calculation?
Yeah.
Which sounds, pretty reasonable. So this huge gap between, like you said, maybe irrational exuberance and this statistical undervaluation, it tells us something, doesn't it? It's not one single market mood.
Not at all. It's like you've got two completely separate fights happening under the same roof.
Yeah.
And our job here is to try and understand the technical language being spoken in both of those fights.
Okay, let's start broad then. Section 1, the aggregate market mood. Looking at all this unattributed data together.
Yeah, let's establish the sort of market's metabolism. How much energy was there at 12:45 p.m.? And we do that by looking at volume across these top 40. Volume is, it's the ultimate gauge of interest, of conviction. And the range we see here is, well, it's pretty telling.
So first up, the daily volume ratios. This compares the volume traded up to 12:45 p.m. against the stock's usual full day's volume for the day before.
Correct. How busy has it been so far today compared to a typical entire day?
And that range is... Wow. Okay, on the low end, some stocks only hit 34% of their previous day's volume. So they're on the list because the absolute volume is high, but compared to their own history, it's actually a slow day.
Exactly. It suggests maybe there was a big block trade early on, maybe pre-market, and then things just sort of died down. The momentum faded by midday. But the real story is at the other end of that spectrum. We've got a stock trading at 239% of its previous day's volume.
Wait, 239%?
Yeah.
By midday?
By midday. Yeah, just think about that for a second. By lunchtime, it's already traded nearly 2.5 times the shares it normally trades in a whole session. That is not normal behavior. That screams catalyst.
Right.
A merger, some crazy earnings surprise, a massive institutional shift. Something big is driving that extreme ratio. It's like a siren. It tells you the usual market structure is just being overwhelmed by the sheer flow of orders.
Okay, so that's the daily picture. How do we refine that? Look at the short-term momentum.
Right. We need the hourly volume ratios. This tells us what's happening right now, or rather in the last 60 minutes leading up to 12:45 p.m. Where is momentum picking up, or where is it fading at this moment? Now, naturally, a lot of stocks slow down by midday. You see some as low as, say, 22% of the previous hour's volume, people taking profits, digesting moves.
But not all of them.
No, not all. We still see acceleration. Specifically, there's one stock hitting 107% of the previous hour's volume.
So more volume in the last hour than the hour before it, midday.
Exactly. That's a strong signal. It suggests maybe a fresh wave of buying or selling hit the tape, could be a delayed reaction to news, or maybe a big fund decided to jump in after their lunch meeting, Understanding this hourly ratio helps you separate the stocks that are just generally popular from the ones that are actively breaking out or breaking down right now.
Okay, so we've got a sense of the energy, the volume, highs, lows, acceleration. Now, let's talk about the psychology, maybe. The price discrepancies and true value metrics. This is where we try to compare the current price to, well, to what? What is true value in this context?
Right, good question. It's important to understand these true value models. They aren't judging the company's fundamental worth, its PE ratio or anything. They're purely technical statistical tools. They look back at historical price action, volatility, how prices tend to revert to a mean over time. And based on that history, they calculate a sort of statistical equilibrium price for different time frames, daily, hourly, etc. They're trying to normalize the price data, essentially.
Which brings us back to that absolutely wild number, the 1,155% overvalue based on the daily time frame. If the model is trying to normalize things based on history, what does a number like that tell us about the market's health or sanity, maybe?
Well, like we touched on, it implies a total dislocation, a breakdown. If the model's job is to find a normal range, and the price is over 1,000% outside that range, it suggests something seismic happened. Either option A, there was completely unforeseen company-altering news, like a buyout offer at 10 times the previous price, something truly massive. Or option B, and this is often more likely in these high-volume, fast-moving situations, it's being driven purely by market mechanics.
Like a short squeeze.
Exactly. A massive short squeeze where sellers have to buy back shares at literally any price to cover their positions. That creates an exponential, almost vertical price surge that has zero connection to the stock's statistical history or fundamentals. The price becomes untethered from reality, basically.
And that wasn't the only sign of frothiness. You mentioned others. Daily overvalue figures hitting 188%, 164%, 105%.
Yeah, several others showing significant overvaluation compared to their daily models. It confirms that momentum was a huge factor. People chasing performance, buying simply because the price is going up, kind of ignoring that longer-term calculated value.
But importantly, it wasn't all one-sided. The market was hedging, you said. We also saw undervalue examples.
Right, you absolutely need that counterpoint. These are stocks where the current price is lagging, sometimes significantly behind that statistically determined true value. We saw a 16% undervalue daily, a 10% undervalue daily, and maybe even more interestingly, a 39% undervalue based just on the 1 hour time frame.
39% undervalued in just the last hour. What does that suggest?
That suggests really aggressive, sudden selling pressure, or maybe a negative headline hit the wires just before 12.45, causing a sort of flash drop in price. The technical models pick that up instantly and flag it as, statistically speaking, mispriced to the downside in that very short window.
Okay, so we had these price extremes, both over and undervalue.
Yeah.
How do we put them in context? We need to know the trend, right? Where do these stocks stand overall?
Absolutely. Context is key. We need the moving averages, MA for that. They give us the trend backdrop.
Let's start long term. The 200 days moving average.
Yeah.
The big one.
Right. The 200 DMA is like the market's long-term health check, and the data here is pretty clear. The vast majority of these top 40 high-volume stocks were reported as being above their 200 DMA.
Okay, so that's generally bullish, isn't it? It means the stocks attracting the most attention, the highest volume, are generally already in established long-term uptrends.
Exactly. It suggests that the big money, the institutional flow, is favoring stocks that are already perceived as winners, or at least fundamentally sound enough to have maintained that long-term uptrend. The market seems to be selecting for strength.
But there's always a but, isn't there? What about the shorter-term trend, the 200 hours moving average? That gives a more recent picture.
It does. If the 200-day MA is the long-term structure, the 200-hour MA, which is roughly, 40 trading sessions, maybe 8 weeks, gives us the recent momentum. And here, the picture gets a bit more complicated.
How so?
It's mixed. While plenty of stocks are still above the 200-hour MA, confirming their short-term strength is intact, a significant number are reported as below.
So, high volume, long-term trend, okay, above 200-day, but recently broken down below the short-term 200-hour.
Precisely. And that tells you something important. It suggests that for some of these names, the high volume we're seeing might actually be driven by selling pressure. Maybe people are selling because the stock just broke its recent uptrend. The battleground, then, is right at that 200-hour MA. Can they reclaim it? Or is this high volume confirming a deeper pullback? That's the tension.
Okay, one last piece for this aggregate view. The very start of the day. The pre-market gaps. How did these stocks kick things off based on that 20-minute pre-market window?
This sets the initial tone, and the range was pretty wide again, from a huge 13% overvalued gap at the open.
Wow, 13% higher right out of the gate.
Yeah, that implies a massive buildup of demand or positive news overnight. The buying pressure was so intense it forced the opening price way up. That often translates into immediate momentum.
And on the other side?
Down to about 4% undervalue. So some stocks definitely started the day on the back foot, but that 13% overvalue really shows the kind of overnight anticipation that can build up.
Got it. Okay, let's shift gears now. Move away from the big picture, the aggregates, and dive into the specific columns in this data. Section 2, decoding the metrics.
Right. Now we get into the individual technical details that define risk, speculation, and how the market is positioned in these specific names. And a really crucial one, especially if you're trading options, is implied volatility rank, or FOVI rank.
Yeah, IV rank. It's often misunderstood, isn't it? It's not just the raw volatility number. Explain that for us.
Exactly. It's a percentile rank. It takes the stock's current implied volatility, that's the market's expectation of how much the price is going to swing in the future, baked into options prices. And it compares that current level to the stock's own IV history over the past year. So a high IV rank, say 90%, means the current expected volatility is higher than 90% of the readings over the last 12 months.
Meaning options are relatively expensive because the market's bracing for bigger than usual moves.
Precisely. Options premiums get jacked up when IV rank is high, and the market at 12:45 p.m., it was split wide open on this.
How wide? Give us the extremes.
Okay, the lowest IV rank on the list was just 7% and N-word. That was for HYG, the high-yield bond ETF.
7%.
Oh.
So current volatility expectation is lower than 93% of the time over the last year.
Yep. It's basically the definition of stable, low expectation. Everyone thinks HYG is just going to sit there. And the DN-word tag means even that tiny expectation is trending lower. Rock solid. Predictable.
Okay. And the other end?
The other end is, well, it's open. Opendoor Technologies. Its IV rank was 169% upward.
Wait, 169%? How can it be over 100%?
Yes, it means the current implied volatility is higher than any reading recorded in the past year. It's literally off the historical chart for the last 12 months, and the upward means that expectation is still climbing.
So the market thinks open is about to experience unprecedented price swings. Chaos, basically.
That's exactly what it implies. Chaos, uncertainty, and explosive outcome is expected, and you can bet the options premiums on open were sky high, punishingly expensive, because the market is pricing in that massive, unpredictable risk.
Wow. The difference between 7% and 169% IV rank on the same list of high-volume stocks, that really paints a picture of a divided market.
It does. Extreme stability coexisting with, well, a potential volcano. You have to know which one you're dealing with.
Okay, let's quickly loop back to the volume metrics now, with that volatility context in mind. That stock hitting 239% daily vol ratio.
Right. When you see that kind of volume alongside potentially high IV, it's not just interest, it's potential liquidity stress. It means the market makers, the folks providing the bids and offers, are having to adjust rapidly to overwhelming, unexpected demand or supply. And that scramble itself can feed into the volatility we just talked about.
Makes sense. And how did this volume picture connect to the start of the day? You mentioned the pre-market gap status breakdown. What did that show overall?
Overall, a definite bullish bias at the open. The source data show that the vast majority of these top 40 high-volume stocks started the day with a gap up.
So most opened higher than they closed the previous day.
Correct, which reinforces what we saw with the 200-day moving average, right? Most stocks were already in long-term uptrends, and then they got another boost from positive pre-market sentiment. Overnight orders, news, anticipation. It created a buoyant start for the majority.
But not universal. You mentioned a couple of exceptions.
Yeah, only two specific instances of a gap down were noted in this top 40 list. A gap down means opening significantly lower than the prior close. One of those, interestingly, was SEQQQ, the inverse NASDAQ ETF we'll talk about later.
Okay. So its rarity suggests the negative overnight sentiment was pretty contained, at least among the big volume movers.
Seems that way. The broad momentum driving the most active stocks was positive at the open.
And what about the ones marked in range? They didn't gap up or down.
Right. In range means they opened pretty close to where they finished the previous day. No significant overnight gap. What's important about those stocks is that all the high volume they accumulated by 12:45 p.m. was generated entirely during the morning session after the bell.
Meaning the catalyst probably hit during market hours.
Exactly. Maybe a big press release came out at 10 a.m. or a massive block trade went through mid-morning. The key is whatever drove the volume wasn't priced in overnight. It happened intraday.
Fascinating. Okay, this is great context. Let's get specific now. Section 3. Time to drill down into the top 10 high-volume movers.
Yes. Volume equals attention, intent. These are the 10 names where the market's focus was most intense at 12:45 p.m. We need to look at how all these metrics we've discussed, price, volume, 4V rank, power, trend, come together for each one.
All right, leading the pack. Number 1, Ford Motor Co. DLL. Ticker F price just under $14, $13.79. But the volume,
Yeah.
nearly 200 million shares.
Astounding.
Yeah, 199.8 million. That's a low price, sure, which can attract retail volume, but look at the other metrics. They suggest something more. Okay, IV rank, moderate, 34% M-word. So the options market isn't panicked despite that massive volume.
Right. Stability there. But the power metrics, that's the tell. It shows buyer up on the daily time frame and buyer up on the hourly time frame.
Consistent buying pressure.
And accelerating.
Exactly. That's pretty rare to see both aligned like that, especially with this kind of volume. Buyers are firmly in control, and their grip is strengthening right now. Combine that with an H trend, a high trend classification.
Meaning strong directional price movement.
Correct. Ford's story at this moment is clear. High volume is translated directly into a powerful, sustained upward move. Looks like accumulation.
Okay, number 2. INTC, Intel Corp. Higher price here, $38.64. Volume still huge, 188.7 million shares. Suggests maybe more institutional fingerprints?
Likely, yeah. The IV rank is 64% N-word. Again, moderate volatility expected. But Intel's story is different. It's about a potential shift in momentum.
How so? Look at the power.
Okay, daily power shows buyer day. So leading up to the last hour, buying strength was actually fading.
Yeah. The hourly power is marked as loading.
Loading. Okay, we need to talk about that term. What does loading signify here?
Loading is a fascinating signal. It suggests that while the obvious buying pressure might have slowed down, hence buyer den daily, there's still significant activity happening beneath the surface. Institutions might be quietly accumulating or distributing shares, preparing for a bigger move, like
Sure.
pressure building up.
So Intel gapped up 3 points at the open, daily buyers faded, but now the hourly chart shows this loading could go either way then.
Exactly. It's a pivot point. That loading could fuel a breakout later in the day, confirming the gap up, or it could precede a breakdown if distribution is happening. High tension there.
Number 3, the one we keep mentioning, Opendoor Tech, $8, $8 and now 96 million shares. We already know that ID rank is off the charts, 169% upward, expecting chaos.
Total chaos priced in. And look at the power dynamic. It explains why the IV is so high. Daily power is seller deans, meaning the longer-term selling pressure has been easing up.
Okay, sellers backing off.
But the hourly power, buyer up. A strong acceleration of buying right now.
So it's a head-on collision. Past selling pressure meets aggressive current buying.
Exactly. That fight, that uncertainty about who wins is why the implied volatility is 169%. The market is saying, we have no idea which way this breaks, but it's going to break big. That's maximum risk reflected in the options price.
Makes sense. Number 4, SQYQQ. That's the ProShares Ultra Pro Short QQQ ETF, an inverse leverage ETF. High volume here means big bets against the NASDAQ, right?
Correct. Or significant hedging. 100.3 million shares traded, price $13.91.
And its gap status was gapped down 8, opened way lower.
Right, suggesting overnight tech optimism. But look at the power now, midday. Daily is buyer den. Buyers of the inverse ETF fading, but hourly is seller up.
Seller up on an inverse ETF means more selling pressure on the actual NASDAQ. Bets against tech are increasing right now.
That's what it suggests. Despite the gap down, the bears betting against the NASDAQ are getting more aggressive in the current hour. Interesting contradiction.
Number 5, another leverage play. TSLL, Direction Daily TSLA Bull 2X Shares ETF. So pure speculation on Tesla going up, amplified, 91.7 million shares.
High risk, high volume speculation,
Yeah.
And it had a huge gap up, 12. Massive optimism at the open for Tesla bulls.
That's the power dynamics now.
Intriguing again. Daily is seller day in, sellers of the bull ETF backing off. But the hourly power is buyer Dan loading.
Okay, break that down. Buyer Dan loading.
It suggests the initial huge buying rush after that big gap up buyer has slowed down day to end, but there's still underlying accumulation happening stealthily, loading.
So the market's taking a breather after the initial surge, but big players might still be adding to their bullish Tesla bets quietly, preparing for the next leg.
That's a very plausible interpretation. The loading hints at conviction beneath the surface pause.
Number 6, the behemoth, NVIDIA Corp. Big price, $185.01. Still massive volume, 72.4 million shares. Fighter rank moderate, 50% N-word.
Yep. And like Intel, the story here seems to be about institutional positioning. Look at the power.
Daily, seller done, hourly, buyer uploading.
See the pattern. Same as TSLL almost. Daily selling pressure eases off, but the hourly shows buyers stepping in up and accumulating significantly loading. NVDA often exemplifies this buy the dip mentality from institutions. The daily might show some selling, but the hourly loading suggests smart money sees midday weakness as a chance to build bigger long positions, especially after a 6-point gap up earlier.
Okay, number 7, AAL, American Airlines Group, 13.87 cents, $70.7 million shares. That's pretty high volume for an airline, isn't it?
It is, yeah. Suggests unusual interest. Foggy rank average, 47% M inward, and the power. Seller dim and buyer uploading.
There it is again, seller Dan daily, buyer uploading hourly. Same pattern as NVIDIA and the Tesla ETF.
Exactly. It suggests that positive sentiment or a specific catalyst, maybe an industry upgrade, good news on fuel costs, who knows, is drawing institutional buying interest into AAL right now, overcoming any earlier selling pressure. Accumulation is underway.
Number 8, RGTI, Rigetti Computing, INC, quantum computing play, 61.5 million shares. Now this one's interesting. IB rank is really high, 143% inward.
The very high volatility expected, yeah. The downward means it's maybe coming off an even higher peak, but 143% is still huge.
But despite the high volume and the high IV rank, its trend classification is N trend. Neutral trend. How does that work?
That's a critical combination to understand. High volume plus high fi plus neutral trend includes intense, violent, two-sided action. It means buyers and sellers are throwing massive amounts of shares at each other, creating huge price swings, hence the high IV, but neither side is winning. They're fighting to a standstill within this measured time window. The net result is no clear directional progress. Stalemate.
Fascinating. And that same trend shows up for number 9, TSLA, Tesla INC itself. Huge price, $435.07, almost 60 million shares traded. It also had that massive 12-point gap up at the open.
Right, and look at its power. Buyer up daily, but buyer down hourly.
Contradiction again. Strong buying overall today, but fading in the last hour.
Exactly, and that explains the end trend. Even with that huge opening gap and strong daily buying, the momentum stalled midday. The hourly buyers couldn't sustain the push. So Tesla, despite the volume and the gap, is stuck in consolidation right now. High volatility maybe, but paused directionally.
Okay, rounding out the top 10. AMD, Advanced Micro Devices, another chip giant, $251.22, just under 50 million shares. 4V, ranked 70% N-ward.
Pretty active IV. And the power. Daily. Seller Dan hourly. Buyer up.
So sellers faded, buyers accelerated in the last hour.
Resulting in a clear H trend. High trend.
So AMD is the opposite of Tesla and Rigetti. Here, the hourly buyers did take control, overcame the earlier sellers, and generated strong directional upward movement. A successful midday reversal.
That's the classic H-trend pattern emerging from conflicting power signals. Buyers won the midday battle decisively.
Excellent breakdown. Okay, section 4. Let's pull back slightly and talk about these forces. Squeeze potential, power dynamics, trend more broadly across the list.
Right. We need to translate these columns into sort of market forces. And the heart of it really is the buyer-seller power dynamics. It's the best immediate sentiment gauge we have here.
And the key takeaway seemed to be the conflict between the daily and hourly readings.
Absolutely. That conflict was common in the top 40. Seeing seller din on the daily, meaning selling pressure was fading overall, combined with buyer up on the hourly, meaning buying accelerated right now, like we saw in Open, NVDA, AMD. That's the signature of an active, unfolding, and often successful intraday reversal. Sellers are giving ground, buyers are pressing the advantage with increasing conviction in that crucial last hour.
And what about the opposite? When they were aligned? Like Ford.
Right. Stocks like F or CIFR further down the list showed buyer up, buyer up. That's consistent strength, unidirectional commitment. It signifies much stronger conviction in the trend both recently and right now. Less conflict, more follow-through generally.
Okay, let's spend a bit more time on that loading signal. You said it's critically important and appear on a lot of big names. INTC, TSLL, NVDA, AAL, even ETFs like QQQ and SPXU, plus PLTR, PBR.
Yes. For anyone listening, you really need to pay attention when you see loading. It's not just jargon. Think of it as a potential footprint of smart money positioning itself.
So explain again. If it says buyer uploading, like on NVDA, it's not just buyers winning, it's stealthier.
Exactly. Loading implies a deliberate, less aggressive accumulation or distribution if it's seller deemed loading. Large institutions or algorithms often don't want to just slam the market and move the price instantly that costs them money. So instead of hitting the offer hard and fast, which would just show buyer up, they use techniques like large limit orders, maybe trading in dark pools to build their position more quietly. Buyer uploading means significant buying is happening, buyer up, but it's being done in a way that builds pressure gradually, loading, rather than causing an immediate price spike. They're absorbing supply without showing their full hand yet.
And when you see this loading on key stocks like NVDA, INTC, or index ETFs like QQQ, what does that imply for the rest of the trading day?
It implies the major players are setting the stage. They're preparing the battlefield for the afternoon session. The market might feel like it's pausing, but underneath, this pressure is building. It means the potential for volatility is actually quite high because eventually that accumulated pressure has to release. The loading suggests a bigger move is being orchestrated.
Got it. Okay, let's talk trend classification. H trend, N trend, N trend. What did the distribution tell us?
The most striking thing was the dominance of H trend, high trend, especially in the top 10 where we saw 8 out of 10.
Meaning most of the high volume action was strongly directional? Price moving steeply one way or the other?
Exactly. It shows that for the most part, the intense volume was resolving the buyer-seller battle decisively within that time frame. One side was clearly winning, creating strong momentum. That's where trend followers want to be.
But then you have the crucial counterpoint. N trend, neutral trend. We saw it for RGTI and TSLA, both with high volume.
Right. And end trend does not mean quiet. It means violent equilibrium. For a stock trading millions of shares like Tesla, end trend confirms that buyers and sellers are locked in a brutal fight. Huge swings up, huge swings down, maybe, but ultimately ending up near where they started within that measurement window. Net zero progress.
So it signifies indecision or intense consolidation before the next big move.
Both are possible. It's a moment where the market is churning, digesting information, and the direction hasn't been chosen yet. High energy, no clear path.
And briefly, M trend, medium trend, found lower down the list.
Yeah, for stocks like RF, Regions Financial, and SNAP-P, it just indicates moderate directional conviction. There's a trend, it's moving, but not with the same steepness or ferocity as the H trend names, a more gradual move.
One last point on the overall picture.
Yeah.
The types of stocks on the list. You mentioned lots of ETFs.
Yes, that's definitely noteworthy. The sheer number of leveraged ETFs, StoQQ, TSLO, SOXL, TQQQ, SPXU, and also crypto-linked ETFs like IBIT and ETHA popping up in the top 40 volume movers, that tells you a lot about the market's appetite at that moment. Meaning a significant chunk of this high volume activity is driven by speculation, amplified risk-taking through leverage, and aggressive hedging strategies. It's not just plain stock picking, it's tactical, often short-term, position jockeying using these high beta instruments.
Okay, great synthesis. Let's wrap this up. Time for the outro. This deep dive into that 12.45 p.m. snapshot. It really shows a market pulling in different directions, doesn't it? To boil it all down for you, we've got 3 key takeaways.
Yeah. First, I think, is the dramatic technical split we saw. On one hand, you have this powerful directional bias, all those H-trend stocks dominating the volume leaders. Clear momentum. But running right alongside that, you have extreme divergence and volatility. Think Open at 169% IV rank versus HYG at 7%. It means you couldn't just apply one strategy across the board. You had to be incredibly specific about the risk profile of almost every single asset. General market assumptions. Probably very dangerous that day.
Good point. Second takeaway.
Second has to be the loading signal. Seeing it pop up so frequently on market giants, NVDA, INTC, QQQ, is a big flag. It strongly suggests that institutional players, the smart money, were actively and quietly positioning themselves midday, building up pressure.
Not retail noise, but calculated positioning.
Right. And that underlying pressure building beneath the surface suggests that maybe the kind of volatility spike we saw in Open could potentially spread to these bigger names later in the afternoon. The stage was being set.
Okay. And the third key takeaway.
Third, we have to come back to that 11,155% overvalue stock. It's an outlier, sure, but it serves as a crucial warning sign. It's a powerful reminder that in high momentum, high volume situations, especially if driven by mechanics like short squeezes or panic buying, traditional valuation models can become completely irrelevant in the short term. Volume and momentum become the only things that matter for immediate price action, not some calculated true value.
Yeah. Statistics versus psychology, and sometimes psychology, or just pure mechanics, wins spectacularly. Okay, that leaves us with our final provocative thought for you to consider. We froze the market at 12:45 p.m. We saw the pressure building with those loading signals. We saw the violent sideways chop in the neutral trend stocks like RGTI and TSLA. So the question is, what happened next? Which way did the market ultimately break in those final hours? Did those end-trend stocks, RGTI and TSLA, finally choose a direction and convert into a strong high trend by the close? Or did the choppy, undecided battle continue? Something to think about until our next deep dive.